So when we are looking at the market, doing some market analysis, we see that because of the enhanced scrutiny on carbon credit quality, only about 25% of credits meet the threshold set by project demand. So people who are looking to either invest in projects or offtake projects or retire those credits and really sort of sign up to sponsor the quality of the project. And that demand is really only increasing, especially as we get closer to 2030 and the utility of carbon credits becomes more clear and the business case builds. Supply is really not sort of matching what is currently available and what will be needed in the future. And for those of us that have worked with corporates or investors who are really looking for projects, I think we really feel that. And when I say 25% of projects only meet the demand criteria, that's not to say that all of those credits or all of those projects actually have available supply for you to procure from. Some of them might be held up in offtakes, some of them might not sort of manifest in the future. And so really the squeeze in terms of supply and finding high quality supply is pushing people further upstream into earlier and earlier phases of the project development lifecycle. So we call this pre-issuance. And when you think about the pre-issuance space, it comes with some unique challenges, right? The registry process, the crediting process comes with a certain level of homogenization, a certain level of what you can come to expect in a project design document, what you can come to expect in a monitoring report, in a verification report. There is some consistency, there are some practices, and there is a minimum level of data disclosure that is required. So before it goes through that process, before it goes through that cycle, project developers may have a different approach to a pre-feasibility or a feasibility study across project types, across regions. So there's not the same kind of consistency. And really, the data might not exist. The project doesn't have a lot of time underneath its belt to demonstrate a certain level of execution. So there are unique risks around data, visibility, and ultimately uncertainty in the pre-issuance space. And I mean, to top it off, 46% of pre-issuance projects fail before they even get to the point of issuing credit. So there are unique risks, but there is also, of course, the upside that comes with being able to participate in the development and the design choices of these carbon credit projects at an earlier stage. Some of the unique challenges that we see and we hear from customers or people operating in this pre-issuance space, people are trying to develop a repeatable risk-based decision-making framework that helps them make sure that they are finding the right projects and investing more off-taking or developing the right projects that are going to meet long-term demand and maintain value over the long run. And so if I am currently trying to find opportunities or projects that meet my criteria, that's a very challenging endeavor. These projects are not yet listed on the registry, and they exist across space and project developers, and it is quite fragmented. So I have limited visibility into the pipeline of projects that are going to be coming online and that meet my criteria. A lot of this is really like human to human based. Who do you know? Where can you find and source these projects? Second is because of the unique challenges and uncertainties, it's leading to prolonged diligence cycles. People are still trying to figure out what makes sense for them, what kind of data they need, what they're comfortable with at a certain stage of the project development lifecycle. So we are really seeing longer diligence cycles associated with pre-issuance versus those processes that are more tailored to spot transactions or off-taking from projects that are already issuing. Then third is, it is a unique challenge, but really an exciting opportunity to see the current choices or the current conditions or the potential pathways that a project could take to as it comes closer to the development cycle. And so for off-takers or investors, it can be hard to know what is going to take them from where the project is today to where it needs to be to meet their quality criteria or manage delivery risk. So there are unclear remediation pathways. And then last, there are unique challenges and costs associated with planning for and budgeting for a pre-issuance offtake or a pre-issuance team. So if you are thinking about how do I talk to the CFO or how do I talk to the VP that is responsible to set budget, to manage the budget, and to set that budget for a longer period of time, it's kind of hard to find the data that will say, okay, this is what we can expect in terms of origination costs associated with participating in earlier phases of the project lifecycle. And then what is the cost benefit analysis for the corrective measures that I can take to really have a say in the project design, and what is that going to mean for me in terms of maybe my P&L in the long run? And then to top it all off, you have the project developers that are trying to bring high quality projects to market that are, focused on, okay, how do I make this a viable project? And they're being pulled in many different directions with fragmented demand and buyer requirements. There's a lot of RFPs that go out there that ask for ultimately the same kind of data, but in a slightly different way. So and at the same time, when buyers and investors are trying to figure out what their procurement and diligence process looks like, we have project developers that are trying to respond and trying to demonstrate that, hey, I have a really great project here, and this is how it's going to meet your criteria. So there is friction between the buy side, demand side, as well as the investors.